friends of Bitcoin are waiting for a new movement. Its success depends on the inflation data in the United States for March, which will be published this Wednesday. Analysts expect a decline in the growth of prices to 5.2%, which will be the largest monthly reduction in inflation since its reversal. This may signal the imminent end of the Federal Reserve's tight monetary policy. However, it should be noted that this inflation rate is calculated on an annual basis, and last year the peak came precisely in the spring-summer, which makes the inflation reduction less significant in practice. In addition, it is necessary to take into account the statistics on the labor market, where unemployment remains at a record low, which can soften the Fed's expectations for cooling the labor market to fight inflation. Low unemployment is an indicator of a strong American economy and a soft landing, which gives hope for the victory over inflation without a recession. Growth is expected in S&P 500 and Bitcoin when inflation falls. If inflation remains within the forecast, the market is likely to remain in place. Bad inflation data can lead to a correction in Bitcoin, and the possibility of a rate cut at the Fed meeting can be a bullish signal for Bitcoin. It is important to keep an eye on expectations for the June Fed meeting. The Fed may raise the rate above 5.25% or stop there. It will be interesting to revisit this issue after the data is published and see how accurate our expectations are. Next, we will look at the Fed's balance sheet and their policy on printing dollars after the banking crisis. The regulator promised to provide unlimited liquidity credit to ensure a 100% return of depositors' funds, but has already reduced its balance by $100 billion and continues to raise the rate. American banks are still losing money, and the outflow of deposits from the banking system continues. The Fed needs to turn its monetary policy around to make deposits more attractive to dollar holders. Raising rates to fight inflation. To compensate for all deposits, $18 trillion is required, and to repay the current deposit run on the bank, around $2 trillion is required. The Fed does not want to do this right now, as it will lead to a new wave of inflation. Bankers will get a lot of money if they need it. Jamie Dimon believes that the banking crisis is not over yet and expects problems that regulators have not faced before. Banks will be offered a non-standard solution to the problem. In fact, credit funds provided to banks at a high interest rate that they will not be able to repay when the Fed lowers the rate. We expect layoffs, office and department closures to optimize expenses. Be very attentive to the situation's development and don't forget that the market can be unpredictable and volatile. It's important to have a good understanding of the situation and respond to changes effectively to minimize risks and maximize potential profits. If you have doubts or questions, seek advice from professional financial consultants to receive qualified recommendations and advice.